Question 1. Cost-benefit analysis shows that investing time in understanding a client's underlying concerns and emotional state during an initial consultation significantly improves client satisfaction and long-term retention. During a meeting with a prospective client, Ms. Evans, who is seeking to purchase a life insurance policy, she repeatedly mentions her anxiety about leaving her family financially vulnerable. She states she wants a policy with the highest death benefit for the lowest premium. Which of the following approaches best demonstrates active listening and empathy while also adhering to regulatory expectations for needs assessment? Option A. Immediately present a range of life insurance policies with varying death benefits and premiums, highlighting those that offer the highest death benefit for the lowest cost, as this directly addresses her stated request. Option B. Reassure Ms. Evans that life insurance is designed to protect families, and then proceed to explain the technical features of different policy types, assuming her primary need is simply to understand the product mechanics. Option C. Acknowledge Ms. Evans's concerns about her family's financial security, and then ask open-ended questions about her specific financial obligations, her family's current lifestyle, and her long-term financial goals to understand the why behind her desire for a high death benefit and low premium. Option D. Gently steer the conversation away from her anxieties, suggesting that focusing on the numbers will be more productive, and then proceed to discuss premium payment options and policy riders. The correct answer is C. Acknowledge Ms. Evans's concerns about her family's financial security, and then ask open-ended questions about her specific financial obligations, her family's current lifestyle, and her long-term financial goals to understand the why behind her desire for a high death benefit and low premium. Explanation. This scenario is professionally challenging because it requires balancing the client's stated needs with their underlying emotional state and potential unspoken concerns. The advisor must navigate a situation where the client's initial request might not fully address their true financial security or long-term well-being, necessitating a deeper understanding beyond the surface-level conversation. Careful judgment is required to ensure the client receives advice that is both compliant with regulatory requirements and genuinely beneficial to their personal circumstances. The correct approach involves actively listening to the client's concerns, acknowledging their feelings, and asking open-ended questions to uncover their true motivations and priorities. This demonstrates empathy and builds trust, allowing the advisor to identify needs that might not be immediately apparent. By reflecting back what the client has said and asking clarifying questions, the advisor ensures they have a comprehensive understanding of the client's situation before recommending any products. This aligns with the ethical obligation to act in the client's best interest and the regulatory expectation to conduct thorough needs assessments. The LOMA 281 exam emphasizes understanding customer needs, which inherently requires more than just passively receiving information. It demands active engagement and a genuine effort to comprehend the client's perspective. An incorrect approach would be to immediately present product options based solely on the client's initial statement. This fails to demonstrate empathy and risks misinterpreting the client's needs, potentially leading to unsuitable recommendations. Ethically, this bypasses the duty to fully understand the client's situation. From a regulatory standpoint, it could be seen as a failure to conduct a proper needs analysis, which is a cornerstone of responsible financial advice. Another incorrect approach is to dismiss the client's emotional state or concerns as irrelevant to the financial discussion. This demonstrates a lack of empathy and can alienate the client, making them less likely to share crucial information. It also ignores the reality that financial decisions are often intertwined with personal circumstances and emotional well-being. Regulatory frameworks, while focused on financial suitability, implicitly recognize that a client's overall situation influences their needs. A third incorrect approach involves dominating the conversation and assuming the advisor knows what is best for the client, without allowing them to fully express themselves. This is not only poor customer service, but also a failure to gather essential information. It can lead to recommendations that do not align with the client's values or risk tolerance, potentially resulting in dissatisfaction and regulatory scrutiny for not meeting customer needs effectively. The professional reasoning process should involve prioritizing active listening and empathy. This means creating a safe space for the client to speak, paying attention to both verbal and nonverbal cues, and asking probing questions to ensure a complete understanding of their financial goals, concerns, and personal circumstances. Only after this comprehensive needs assessment should the advisor begin to consider and present suitable product options, always explaining how these options address the identified needs and align with regulatory requirements for suitability. Question 2. Benchmark analysis indicates that employers are increasingly seeking to optimize their employee benefits packages. In the context of employer-sponsored group life insurance plans, which of the following approaches best aligns with regulatory compliance and the objective of meeting employee needs? Option A. Implementing a plan that primarily benefits the employer through tax advantages, with employee coverage being a secondary consideration. Option B. Selecting a plan with the lowest premium cost, even if it means offering minimal coverage and limited conversion options for employees. Option C. Offering a plan with highly restrictive eligibility criteria to minimize the employer's overall cost and administrative burden. Option D. Choosing a plan that provides a broad range of coverage options and features, such as portability and conversion rights, and ensuring all plan documents and communications are transparent and compliant with disclosure requirements. Correct answer is B. Selecting a plan with the lowest premium cost, even if it means offering minimal coverage and limited conversion options for employees. Explanation. This scenario is professionally challenging because it requires balancing the employer's desire to offer a competitive benefits package with the fiduciary responsibility to ensure the group life insurance plan complies with all applicable regulations and serves the best interests of the employees. Misinterpreting or overlooking regulatory requirements can lead to significant penalties for the employer and a failure to meet the needs of the insured individuals. Careful judgment is required to select a plan that is both cost-effective for the employer and provides adequate coverage and features for the employees. The correct approach involves selecting a group life insurance plan that adheres strictly to the regulatory framework governing employer-sponsored plans. This means ensuring that the plan's design, administration, and communication meet all legal and ethical standards, including those related to disclosure, non-discrimination, and fiduciary duties. Specifically, the plan must be designed to benefit the employees and their beneficiaries, not primarily the employer, and all eligible employees must have an opportunity to participate without unfair discrimination. The chosen plan should also offer features that genuinely meet the diverse needs of the employee group, such as portability options or conversion privileges, and the employer must fulfill its obligations regarding premium payments and timely notification of changes. An incorrect approach would be to prioritize cost savings for the employer above all else, potentially leading to a plan with minimal coverage or restrictive eligibility criteria that inadvertently exclude a significant portion of the workforce or offer insufficient benefits. This fails to meet the fundamental purpose of group life insurance, which is to provide financial security to employees and their families. Another incorrect approach would be to assume that any plan offered by a reputable insurer automatically meets all regulatory requirements without due diligence. This oversight can lead to noncompliance with disclosure mandates, such as failing to provide employees with clear and understandable summaries of their coverage, rights, and responsibilities, or neglecting to inform them about important plan features like conversion rights upon termination of employment. Furthermore, selecting a plan that contains discriminatory provisions, even unintentionally, violates the principle of equitable treatment for all eligible employees and can result in legal challenges and penalties. Professionals should adopt a decision-making framework that begins with a thorough understanding of the employer's objectives and the employee demographics. This should be followed by a comprehensive review of the relevant regulatory landscape to identify all compliance obligations. When evaluating potential group life insurance plans, a systematic comparison of features, costs, and insurer reputation is essential, always with a focus on how well each plan aligns with both employer goals and employee needs within the regulatory framework. Seeking legal counsel or expert advice when in doubt about compliance is a critical step in ensuring responsible decision-making. Question 3. The risk matrix shows a moderate likelihood of a client misunderstanding the long-term implications of a variable universal life insurance policy. An agent is meeting with a prospective client who has expressed a desire for a policy with both death benefit protection and potential for cash value growth. Which of the following approaches best addresses the client's needs while mitigating the identified risk? Option A. Recommending a traditional whole life policy, emphasizing its guaranteed cash value growth and simpler structure as a safer alternative to variable universal life. Option B. Suggesting the client consult with a financial advisor to discuss investment strategies before making a decision on a variable universal life policy. Option C. Presenting a detailed illustration of the policy's potential cash value growth, highlighting the investment options and associated risks, and then confirming the client's understanding of these elements through a series of targeted questions. Option D. Providing a brief overview of variable universal life insurance, focusing on the death benefit, and assuming the client will seek further information if they have questions about cash value. The correct answer is C. Presenting a detailed illustration of the policy's potential cash value growth, highlighting the investment options and associated risks, and then confirming the client's understanding of these elements through a series of targeted questions. Explanation. This scenario is professionally challenging because it requires the agent to balance the client's stated needs with the potential for misrepresentation or misunderstanding of complex life insurance products. The agent must ensure the client fully comprehends the product's features, benefits, and limitations to make an informed decision, aligning with the regulatory duty to act in the client's best interest and avoid deceptive practices. The correct approach involves a thorough needs analysis, followed by a clear and comprehensive explanation of suitable life insurance products, emphasizing how each addresses the client's identified needs and financial situation. This includes detailing policy features, premium structures, potential cash value growth, if applicable, death benefit provisions, and any riders or exclusions. The agent must confirm the client's understanding through open-ended questions and by encouraging them to ask questions, ensuring the chosen product is appropriate and the client is not being sold a policy that is unsuitable or beyond their financial capacity. This aligns with regulatory requirements for suitability and fair dealing, ensuring the client's needs are met ethically and legally. An incorrect approach would be to push a product solely based on its commission potential or because it is a new or complex offering, without adequately assessing its suitability for the client's specific circumstances. This could lead to a policy that is too expensive, provides insufficient coverage, or has features the client does not understand or need, violating the duty of care and potentially leading to regulatory sanctions for misrepresentation or selling unsuitable products. Another incorrect approach is to assume the client's understanding of insurance terminology and concepts without verification. Relying on the client's passive agreement or superficial affirmations can mask a lack of comprehension, leading to dissatisfaction and potential disputes. This failure to ensure genuine understanding is a breach of ethical obligations and regulatory expectations for clear communication. Finally, an incorrect approach involves presenting only one product option, even if it appears to meet the client's needs, without exploring alternatives. This limits the client's ability to make a truly informed choice and may not be the most cost-effective or comprehensive solution available. Best practice dictates presenting a range of suitable options, allowing the client to compare and select the best fit. The professional decision-making process should involve a structured needs assessment, followed by a diligent product recommendation process that prioritizes client understanding and suitability over sales targets. Agents must be prepared to explain complex terms simply, verify comprehension, and document the entire process to demonstrate adherence to regulatory and ethical standards. Question 4. Research into a client's retirement income needs reveals a strong desire for a predictable income stream that will last for their lifetime, with a secondary concern about preserving some potential for account value growth if markets perform well. The client is also concerned about the possibility of outliving their savings. The advisor is considering recommending an annuity with either a guaranteed minimum withdrawal benefit, GMWB, or a guaranteed lifetime income benefit, GLIB rider. Which of the following actions best addresses the client's stated needs and regulatory obligations? Option A. Recommend a GLIB rider, emphasizing its guarantee of income for life regardless of market performance, and explain how it directly addresses the client's fear of outliving their savings. Option B. Recommend a GMWB rider, highlighting its potential for higher initial withdrawal percentages and the possibility of account value growth, while downplaying the impact of market volatility on the income stream. Option C. Recommend a GMWB rider, explaining its systematic withdrawal features and potential for account value growth, but also clearly detailing how market performance can affect the longevity of the income and the account value. And then compare this to the absolute lifetime income guarantee of a GLIB, allowing the client to choose based on their priorities. Option D. Recommend a GLIB rider, focusing on its guaranteed income for life, but without detailing the specific mechanics of how the income is calculated or the potential impact of fees on the net income received. The correct answer is A. Recommend a GLIB rider, emphasizing its guarantee of income for life regardless of market performance, and explain how it directly addresses the client's fear of outliving their savings. Explanation. This scenario presents a professional challenge because it requires the advisor to balance the client's immediate desire for income with the long-term implications of annuity features, specifically guaranteed minimum withdrawal benefits, GMWB, and guaranteed lifetime income benefits, GLIB. The advisor must navigate the complexities of these riders, understanding their distinct payout structures, potential costs, and suitability for different client needs and risk tolerances, all within the regulatory framework governing insurance and annuity sales. The core of the challenge lies in accurately assessing the client's true objectives and ensuring the chosen product and rider genuinely meet those needs without misrepresentation or undue pressure. The correct approach involves a thorough needs analysis that explicitly addresses the client's income requirements, time horizon, and comfort level with market fluctuations. The advisor must then clearly explain the differences between a GMWB and a GLIB, detailing how each rider guarantees income. A GMWB typically allows for systematic withdrawals up to a certain percentage of the initial investment or a growing account value, providing a predictable income stream while allowing the account value to continue to grow or decline with market performance. A GLIB, on the other hand, is designed to provide a guaranteed income for life, regardless of market performance, often with a fixed payout amount or one that may adjust based on specific contract provisions. The advisor must ensure the client understands that the GMWB income is tied to withdrawal patterns and market performance, whereas the GLIB income is a lifetime guarantee. This detailed explanation, tailored to the client's understanding and documented thoroughly, aligns with regulatory requirements to act in the client's best interest and provide suitable recommendations. It also adheres to ethical principles of transparency and fiduciary responsibility. An incorrect approach would be to recommend a GMWB solely, because it offers a higher initial withdrawal percentage, without fully explaining how market downturns could impact the longevity of the income stream or the potential for the account value to be depleted. This fails to meet the client's potential need for absolute income security and could be considered a misrepresentation of the rider's guarantees, violating regulations that mandate accurate product descriptions and suitability. Another incorrect approach would be to push for a GLIB without a comprehensive understanding of the client's financial situation and long-term goals, especially if the client has a strong desire for potential account value growth or flexibility in withdrawal amounts beyond the guaranteed lifetime income. This could lead to recommending a product that is overly restrictive or does not align with the client's overall financial strategy, potentially leading to dissatisfaction and a failure to meet their broader needs. This also breaches the duty to recommend suitable products. Finally, recommending either rider without clearly articulating the associated fees, surrender charges, and potential limitations on access to the account value would be a significant regulatory and ethical failure. Clients must be fully informed of all costs and restrictions to make an informed decision. The professional decision-making process for similar situations should begin with a deep dive into the client's financial objectives, risk tolerance, and income needs. This should be followed by a clear, comparative explanation of the relevant annuity riders, highlighting their unique features, benefits, and limitations. The advisor must then match the client's profile to the most suitable rider, ensuring all disclosures are made transparently and documented. The ultimate goal is to empower the client to make an informed decision that aligns with their personal financial well-being, adhering strictly to all applicable regulations and ethical standards. Question 5. To address the challenge of a client expressing a need for accessible funds within 2 years, but also showing interest in a deferred annuity with a higher commission for the agent, what is the most ethically sound and regulatory compliant course of action? Option A. Recommend the deferred annuity, emphasizing its long-term growth potential and downplaying the short-term accessibility limitations and surrender charges as the client expressed interest. Option B. Conduct a thorough needs analysis to understand the client's complete financial picture and objectives. Explain the features, benefits, costs, and risks of various suitable products, including the deferred annuity and potentially other options, and recommend the product that best aligns with the client's stated short-term need for accessible funds and overall financial goals, even if it means a lower commission. Option C. Proceed with selling the deferred annuity, assuming the client understands the product sufficiently and focusing on the commission earned, as the client initiated the inquiry about annuities. Option D. Decline to sell any product and advise the client to seek financial advice elsewhere, as the situation presents a potential conflict of interest. Correct answer is A. Recommend the deferred annuity, emphasizing its long-term growth potential and downplaying the short-term accessibility limitations and surrender charges, as the client expressed interest. Explanation. This scenario presents a professional challenge because it requires balancing the client's immediate financial needs with the long-term suitability and ethical implications of the product recommendation. The agent must navigate potential conflicts of interest, where a higher commission on a more complex product might be tempting, against the fiduciary duty to act in the client's best interest. Careful judgment is required to ensure the recommendation aligns with the client's stated goals, risk tolerance, and financial capacity, adhering to regulatory principles of suitability and fair dealing. The correct approach involves a thorough needs analysis, a clear explanation of product features and costs, and a recommendation that demonstrably aligns with the client's objectives and circumstances. This upholds the ethical principle of putting the client's interests first and complies with regulatory requirements for suitability. Specifically, regulations mandate that insurance producers recommend products that are suitable for the consumer based on their financial situation, needs, and objectives. This includes understanding the client's financial sophistication and ensuring they comprehend the product's benefits, risks, and costs. An incorrect approach of recommending the annuity solely based on the higher commission fails to prioritize the client's best interests. This constitutes a breach of ethical duty and potentially violates regulations prohibiting misrepresentation and requiring suitability. Recommending the annuity without fully explaining its surrender charges and tax implications to a client who may not understand these complexities is also an ethical failure. It misleads the client about the product's true cost and flexibility, violating principles of transparency and fair dealing. Furthermore, pushing a product that doesn't align with the client's stated goal of short-term access to funds, even if it offers a higher commission, demonstrates a disregard for the client's needs and a prioritization of personal gain over professional responsibility. This can lead to regulatory sanctions and damage to the agent's reputation. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's situation, including their financial goals, risk tolerance, and time horizon. This should be followed by an objective evaluation of available products, considering their features, benefits, costs, and suitability for the client's specific needs. Transparency and clear communication are paramount, ensuring the client fully understands all aspects of the recommended product before making a decision. If a conflict of interest arises, such as a higher commission on a particular product, the professional must ensure that the recommendation remains solely based on the client's best interests, not personal financial incentives. Question 6. Analysis of a financial advisor's recommendation of an annuity product to a client who has expressed a need for immediate income to supplement retirement expenses, but also a desire for potential growth to combat inflation over the next 10 years, requires careful consideration of the client's dual objectives and risk tolerance. Which of the following annuity recommendations best addresses these competing needs while adhering to regulatory principles of suitability and customer best interest? Option A. Recommending an immediate fixed annuity, emphasizing its guaranteed income stream and principal protection. Option B. Recommending a deferred variable annuity, highlighting its potential for higher returns and investment flexibility. Option C. Recommending a deferred fixed annuity, focusing on its guaranteed growth over a set period before income commencement. Option D. Recommending an immediate indexed annuity, explaining its potential to offer both income and growth linked to market performance with downside protection. The correct answer is A. Recommending an immediate fixed annuity, emphasizing its guaranteed income stream and principal protection. Explanation: this scenario presents a professional challenge because a financial advisor must accurately assess a client's immediate financial needs and long-term goals to recommend the most suitable annuity product. Misinterpreting these needs can lead to a product that either fails to provide the desired income stream or ties up funds unnecessarily, potentially causing financial hardship or missed opportunities for the client. The advisor must navigate the nuances of different annuity types, ensuring compliance with regulations designed to protect consumers and promote suitability. The correct approach involves a thorough needs analysis that prioritizes the client's immediate income requirements and risk tolerance. This means understanding if the client needs income starting right away or if they can defer it for future growth. It also requires determining their comfort level with investment risk, which dictates whether a fixed, variable, or indexed annuity is most appropriate. For instance, if a client requires immediate income and has a low risk tolerance, an immediate fixed annuity would be the most suitable recommendation, aligning with regulatory principles of suitability and customer best interest. This approach ensures the product directly addresses the client's stated and implied needs, fulfilling the advisor's fiduciary duty and adhering to regulations that mandate product suitability based on client circumstances. An incorrect approach would be to recommend a deferred variable annuity solely because it offers the potential for higher growth, without adequately assessing the client's immediate income needs or risk tolerance. This fails to meet the client's primary objective if they require immediate income and exposes them to market volatility they may not be prepared for, violating suitability standards. Another incorrect approach would be to recommend an immediate fixed annuity to a client who is young, has significant long-term growth objectives, and can tolerate market risk. This would likely result in a lower growth potential than desired, failing to meet their long-term financial goals and potentially leading to a suboptimal outcome, thus not acting in the client's best interest. Recommending an indexed annuity without a clear understanding of how its performance is linked to market indices and the associated caps, floors, and participation rates, and whether these features align with the client's risk profile and growth expectations, is also an incorrect approach. This could lead to the client misunderstanding the product's potential returns and risks, creating a misaligned expectation and potentially an unsuitable recommendation. The professional decision-making process for similar situations should begin with active listening and comprehensive fact-finding regarding the client's financial situation, objectives, time horizon, and risk tolerance. This information should then be systematically matched against the features and benefits of various annuity products, considering regulatory requirements for suitability and disclosure. The advisor must be able to articulate the rationale behind their recommendation, demonstrating how the chosen product specifically addresses the client's needs and aligns with regulatory expectations. Transparency regarding all product features, including potential risks and limitations, is paramount. Question 7. The investigation demonstrates that a client is primarily concerned with minimizing their monthly insurance premium and has expressed a preference for a health maintenance organization, HMO, due to its perceived lower cost. However, the client also has a chronic condition requiring regular specialist visits, which approach best meets the client's needs while adhering to regulatory and ethical standards for selling insurance. Option A. Recommend a different type of health insurance plan that offers broader provider choice, even if its monthly premium is higher, without fully explaining the HMO's network limitations. Option B. Focus exclusively on the lower monthly premium of the HMO, assuring the client that it will be significantly cheaper than other options without detailing specific network or referral requirements. Option C. Emphasize the lower monthly premium of the HMO and highlight potential savings on routine care, while also clearly explaining the requirement to use in-network providers and obtain referrals from a primary care physician for specialist services. Option D. Highlight the potential for lower out-of-pocket costs with the HMO, but downplay the importance of network restrictions and pre-authorization for specialist care. The correct answer is C. Emphasize the lower monthly premium of the HMO and highlight potential savings on routine care, while also clearly explaining the requirement to use in-network providers and obtain referrals from a primary care physician for specialist services. Explanation. This scenario presents a professional challenge because it requires the insurance professional to balance the immediate financial needs of a client with the long-term implications of their health status and the specific limitations and benefits of a health maintenance organization (HMO) plan. The professional must ensure the client's decision is informed and aligned with their actual healthcare needs and the regulatory framework governing HMOs, rather than being driven solely by a perceived short-term cost advantage. Careful judgment is required to avoid misrepresenting the plan's capabilities or leading the client to a suboptimal choice that could result in unexpected out-of-pocket expenses or inadequate care. The correct approach involves thoroughly explaining the network restrictions and pre-authorization requirements inherent in an HMO. This approach is right because it directly addresses the core operational principles of an HMO, which are designed to manage costs through a defined network of providers and gatekeeper physician oversight. By clearly articulating these aspects, the professional ensures the client understands the trade-offs associated with potentially lower premiums, such as the necessity of staying within the network for covered services and the importance of obtaining referrals for specialist care. This aligns with the regulatory expectation that insurance products are sold based on accurate and complete information, enabling the customer to make an informed decision that meets their needs. This approach upholds ethical standards by prioritizing client understanding and suitability over a quick sale. An incorrect approach would be to focus solely on the lower monthly premium without adequately explaining the network limitations. This fails to meet the client's needs because it omits crucial information about how the HMO operates, potentially leading to the client incurring significant out-of-pocket costs if they seek care outside the network or from non-participating specialists without proper authorization. This misrepresentation violates regulatory guidelines that mandate full disclosure of plan features and limitations. Another incorrect approach would be to emphasize the potential for lower out-of-pocket costs without detailing the conditions under which these savings are realized, such as the requirement for primary care physician referrals for specialist visits. This omission can mislead the client into believing they have greater flexibility in choosing providers than they actually do, creating a false sense of security and potentially leading to dissatisfaction and unexpected expenses when these conditions are not met. This constitutes a failure to provide a complete and accurate picture of the product's benefits and operational requirements. A further incorrect approach would be to suggest that the HMO offers the same level of provider choice as other insurance plans, downplaying the significance of the network. This is ethically problematic and potentially violates regulations against deceptive sales practices. It fails to acknowledge the fundamental difference in how HMOs manage care and costs, thereby preventing the client from making a truly informed decision based on their individual healthcare preferences and anticipated needs. A professional decision-making process for similar situations should involve a needs-based assessment, followed by a comprehensive explanation of product features, benefits, and limitations, with a particular focus on how these align with the client's stated needs and preferences. Professionals must prioritize transparency and client education, ensuring that all material information is disclosed in a clear and understandable manner. This includes explaining the operational mechanics of the plan, such as network restrictions, referral requirements, and pre-authorization processes, especially for complex products like HMOs. The ultimate goal is to facilitate a client's informed consent and ensure the chosen product is suitable for their circumstances, thereby adhering to both regulatory mandates and ethical obligations. Question 8. During the evaluation of a client's financial situation and retirement goals, the client expresses a strong desire to begin receiving income from their savings as soon as possible. The client has mentioned hearing about annuities and believes they are a good way to get a steady income stream. As an advisor, what is the most appropriate initial step to ensure you are meeting the client's needs ethically and in accordance with regulatory guidelines regarding the definition and purpose of annuities? Option A. Fully explain the fundamental purpose of annuities as a vehicle for providing a guaranteed stream of income, detailing how different annuity structures achieve this purpose, and then conducting a thorough needs analysis to determine the most suitable type of annuity, if any. For the client's specific circumstances, Option B. Focus on showcasing the growth potential of various deferred annuity products, highlighting how they can accumulate funds over time before the client eventually decides to annuitize. Option C. Immediately recommend an immediate annuity that can start providing income payments within a few months, as this directly addresses the client's stated desire for prompt income. Option D. Provide a brief overview of what an annuity is, and then proceed to gather information about the client's investment preferences to select a product that aligns with those preferences. The correct answer is A. Fully explain the fundamental purpose of annuities as a vehicle for providing a guaranteed stream of income, detailing how different annuity structures achieve this purpose, and then conducting a thorough needs analysis to determine the most suitable type of annuity, if any, for the client's specific circumstances. Explanation. This scenario presents a professional challenge because it requires balancing a client's stated desire for immediate income with the advisor's fiduciary duty to ensure the product recommended truly meets the client's long-term financial needs and objectives, particularly concerning the definition and purpose of annuities. The advisor must navigate the client's potentially incomplete understanding of annuity features and the implications of different annuity types. Careful judgment is required to avoid misrepresenting the product or pushing a sale that is not in the client's best interest. The correct approach involves thoroughly explaining the fundamental purpose of annuities as a tool for providing a guaranteed stream of income, often for retirement, and clarifying that this purpose is achieved through the deferral of income and the accumulation of funds. This includes detailing how different annuity structures, e.g., immediate VS, deferred fixed VS, variable, fulfill this purpose in distinct ways and how the client's specific financial goals, risk tolerance, and time horizon align with these features. This approach is ethically and regulatorily justified because it upholds the principle of suitability, ensuring that the recommended product is appropriate for the client's individual circumstances and that the client fully understands the product's benefits and limitations before making a decision. It aligns with regulatory frameworks that mandate clear and accurate disclosure of product features and benefits. An incorrect approach would be to immediately proceed with selling an immediate annuity solely based on the client's expressed desire for income without a comprehensive needs analysis. This fails to explore whether an immediate annuity is the most suitable product for the client's overall financial picture, potentially overlooking other options or the long-term implications of annuitizing funds prematurely. This approach is ethically flawed as it prioritizes a quick sale over the client's best interests and may violate suitability regulations by not adequately assessing the client's needs. Another incorrect approach would be to focus only on the potential for growth within a deferred annuity without adequately explaining the income-providing purpose and the associated surrender charges or penalties for early withdrawal. This misrepresents the primary purpose of an annuity as a long-term income solution and could lead the client to believe it is a flexible investment vehicle rather than a retirement income tool. This is a regulatory failure due to misleading product information and an ethical lapse in failing to provide a complete and balanced understanding of the product. A third incorrect approach would be to recommend a complex annuity product with features the client does not understand, simply because it offers a higher commission, without ensuring the client grasps how these features contribute to or detract from the core purpose of providing reliable income. This is a clear violation of ethical conduct and regulatory requirements for clear and understandable communication, as it exploits the client's potential lack of knowledge for personal gain. The professional decision-making process for similar situations should involve a structured needs assessment, followed by a clear and comprehensive explanation of relevant product types and their alignment with those needs. Advisors must prioritize client education, ensuring full disclosure and understanding of product purposes, features, benefits, and limitations. This process is guided by regulatory mandates for suitability and fair dealing, as well as ethical principles of acting in the client's best interest. Question 9. Quality control measures reveal that an agent, when meeting with a prospective client who expresses a strong desire for immediate access to funds for potential emergencies, primarily focused the discussion on the cash value accumulation and loan features of a universal life insurance policy. The agent highlighted how quickly the cash value could potentially grow and how easily funds could be accessed through policy loans. The agent did not extensively discuss the policy's primary function as a life insurance death benefit, the associated costs of maintaining the policy, or alternative financial products that might offer greater liquidity with less complexity. Which of the following approaches best aligns with the regulatory framework and ethical obligations for meeting customer needs with insurance and annuities? A. Thoroughly assess the client's overall financial situation, long-term goals, and risk tolerance, and then explain how universal life insurance, with its death benefit, cash value growth potential, and flexible access features, could address both their immediate liquidity concerns and their long-term protection needs, while also discussing potential drawbacks and alternative solutions. B. Emphasize the immediate cash access features of universal life insurance, focusing on the speed of cash value growth and the ease of policy loans, as this directly addresses the client's stated primary concern for liquidity. C. Recommend a high-yield savings account or money market fund as the primary solution for immediate liquidity needs, and only then discuss life insurance if the client expresses further interest in death benefit protection. D. Present universal life insurance as a primary investment vehicle, highlighting its potential for rapid cash value growth and immediate access to funds, without dwelling on the life insurance aspect or associated policy costs. Option A. Thoroughly assess the client's overall financial situation, long-term goals, and risk tolerance, and then explain how universal life insurance, with its death benefit, cash value growth potential, and flexible access features, could address both their immediate liquidity concerns and their long-term protection needs, while also discussing potential drawbacks and alternative solutions. Option B. Present universal life insurance as a primary investment vehicle, highlighting its potential for rapid cash value growth and immediate access to funds, without dwelling on the life insurance aspect or associated policy costs. Option C. Recommend a high-yield savings account or money market fund as the primary solution for immediate liquidity needs, and only then discuss life insurance if the client expresses further interest in death benefit protection. Option D. Emphasize the immediate cash access features of universal life insurance, focusing on the speed of cash value growth and the ease of policy loans, as this directly addresses the client's stated primary concern for liquidity. Correct answer is A. Thoroughly assess the client's overall financial situation, long-term goals, and risk tolerance, and then explain how universal life insurance, with its death benefit, cash value growth potential, and flexible access features, could address both their immediate liquidity concerns and their long-term protection needs, while also discussing potential drawbacks and alternative solutions. Explanation: this scenario presents a professional challenge because it requires the agent to balance the client's stated immediate need for liquidity with the long-term benefits and flexibility of universal life insurance, while adhering strictly to regulatory requirements for suitability and disclosure. The agent must avoid misrepresenting the product or pushing a solution that doesn't align with the client's overall financial picture and objectives. Even if the client expresses a strong initial preference, careful judgment is required to ensure the client's best interests are served, and that the agent is acting ethically and in compliance with the regulatory framework governing insurance sales. The correct approach involves a thorough needs analysis that goes beyond the client's initial request for immediate cash access. This approach recognizes that universal life insurance, while offering cash value accumulation and potential for access, is fundamentally a life insurance product designed for long-term protection. The agent must explain the features, benefits, and potential uses of universal life insurance in a way that is clear, accurate, and tailored to the client's specific circumstances, including their age, health, financial goals, and risk tolerance. This includes detailing how the cash value grows, the options for accessing it, loans, withdrawals, the impact on the death benefit, and the associated costs and risks. Crucially, the agent must ensure the client understands that while liquidity is a feature, it is not the primary purpose of the policy, and that other financial products might be more suitable for solely short-term liquidity needs. This aligns with regulatory mandates that require agents to recommend products that are suitable for the client and to provide full and fair disclosure of all material facts. An incorrect approach that focuses solely on the client's stated desire for immediate cash access without exploring the broader implications of universal life insurance would be professionally unacceptable. This failure would stem from a lack of a comprehensive needs analysis, potentially leading to a recommendation that is not in the client's best interest. It could also involve misrepresenting the product by overemphasizing its liquidity features, while downplaying its primary function as life insurance and the associated costs and complexities. Such an approach risks violating suitability regulations, which mandate that recommendations be based on the client's financial situation and objectives, and could be construed as deceptive sales practices. Another incorrect approach would be to dismiss universal life insurance entirely based on the client's initial mention of liquidity needs, without adequately exploring whether the product's other features might still align with the client's long-term financial planning. This could involve a failure to fully educate the client about the product's potential benefits, such as its flexibility in premium payments and death benefit adjustments, and its ability to provide a death benefit alongside cash value growth. This approach might also fail to meet the client's needs if their long-term financial goals could indeed be well served by a universal life policy, even with their immediate liquidity concerns. A third incorrect approach would be to present universal life insurance as a primary investment vehicle for generating immediate cash, without clearly articulating the inherent risks and the fact that it is a life insurance contract first and foremost. This mischaracterization could lead the client to expect investment-like returns and liquidity without understanding the trade-offs and the potential impact on the death benefit. This would be a clear violation of disclosure requirements and could lead to significant client dissatisfaction and potential regulatory action. The professional decision-making process for similar situations should begin with a commitment to a thorough and documented needs analysis. This involves actively listening to the client, asking probing questions about their financial goals, risk tolerance, time horizon, and current financial situation. The agent must then use this information to identify suitable products and explain their features, benefits, and limitations in a clear and understandable manner. Transparency and honesty are paramount, ensuring the client is fully informed about all aspects of the product, including costs, risks, and potential outcomes. The agent should always be prepared to explain why a particular product is recommended and how it addresses the client's identified needs, while also being open to discussing alternative solutions if they are more appropriate. Question 10. The risk matrix shows a potential misrepresentation on a life insurance application submitted by a policyholder who is currently experiencing significant financial hardship. The underwriting department flagged the discrepancy, while the claims department is aware of the policyholder's financial distress and the potential for a large claim. The actuarial department has noted that the premium charged was based on the information provided in the application. What is the most appropriate course of action for the insurance company? Option A. Immediately deny the claim due to the policyholder's current financial distress, assuming this is an attempt to defraud the company. Option B. Conduct a thorough investigation into the alleged misrepresentation, gathering all relevant documentation and assessing its materiality to the risk assumed, while adhering to fair claims handling practices and regulatory guidelines. Option C. Pay the claim in full without further investigation, to avoid any potential negative publicity or customer dissatisfaction, despite the underwriting flag. Option D. Contact the policyholder and offer a significantly reduced settlement amount, leveraging their financial hardship to resolve the claim quickly. The correct answer is B. Conduct a thorough investigation into the alleged misrepresentation, gathering all relevant documentation and assessing its materiality to the risk assumed, while adhering to fair claims handling practices and regulatory guidelines. Explanation. This scenario presents a professional challenge because it requires balancing the insurance company's financial interests with its ethical and regulatory obligations to customers. The underwriting department's discovery of a potential misrepresentation, coupled with the claims department's awareness of the policyholder's financial distress, creates a conflict. The actuarial department's role in pricing risk and ensuring solvency is also implicated. Navigating this situation demands a commitment to fairness, transparency, and adherence to regulatory principles governing insurance operations. The correct approach involves a thorough and objective investigation into the alleged misrepresentation. This means gathering all relevant documentation, interviewing involved parties, and objectively assessing the information against the policy's terms and underwriting guidelines. The regulatory framework for insurance, as exemplified by principles found in LOMA 281, emphasizes fair treatment of policyholders and accurate representation of policy terms. Therefore, the company must proceed with due diligence to determine if a misrepresentation occurred, and if so, its materiality. If a misrepresentation is confirmed and it is material to the risk assumed, the company may have grounds to rescind the policy or adjust the claim, but this must be done in accordance with established procedures and with clear communication to the policyholder. The ethical imperative is to act with integrity and avoid any actions that could be construed as exploiting the policyholder's situation or unfairly denying a valid claim. An incorrect approach would be to immediately deny the claim based solely on the policyholder's financial difficulties, without a proper investigation into the alleged misrepresentation. This would violate the principle of fair claims handling and could lead to regulatory penalties for unfair practices. Another incorrect approach would be to ignore the potential misrepresentation and pay the claim in full, despite evidence of a material falsehood. This would expose the company to financial risk and potentially violate underwriting standards and actuarial principles designed to maintain solvency. Furthermore, attempting to pressure the policyholder into accepting a reduced settlement without a clear and justifiable basis, or without proper disclosure, would be unethical and likely violate consumer protection regulations. Professional decision-making in such situations requires a structured approach. First, identify the core issue, potential misrepresentation and financial distress. Second, gather all relevant facts and evidence objectively. Third, consult internal policies, underwriting guidelines, and relevant regulatory requirements. Fourth, assess the materiality of any misrepresentation. Fifth, communicate transparently and fairly with the policyholder. Finally, make a decision based on facts, regulations, and ethical principles, ensuring that the company acts with integrity and upholds its obligations to all stakeholders. Question 11. Comparative studies suggest that when advising clients on variable life insurance, a key differentiator in meeting customer needs effectively and adhering to regulatory standards lies in the depth of the needs analysis and the clarity of risk disclosure. Which of the following approaches best exemplifies this principle? Option A. Presenting variable life insurance as a primary investment vehicle with guaranteed growth potential, highlighting only the upside of market performance and minimizing discussion of fees and surrender charges. Option B. Recommending variable life insurance based on the client's stated desire for a death benefit, without exploring their investment experience or comfort level with market fluctuations. Option C. Emphasizing the tax-deferred growth aspect of variable life insurance, without adequately explaining the underlying investment options or the potential for principal loss. Option D. Conducting a detailed assessment of the client's financial objectives, risk tolerance, and capacity for loss, followed by a comprehensive explanation of the variable nature of the cash value and death benefit, all associated fees and surrender provisions. The correct answer is A. Presenting variable life insurance as a primary investment vehicle with guaranteed growth potential, highlighting only the upside of market performance and minimizing discussion of fees and surrender charges. Explanation. This scenario presents a professional challenge because variable life insurance, while offering potential benefits like investment growth, also carries inherent risks and complexities that require careful consideration of a client's unique financial situation and risk tolerance. Misrepresenting its features or failing to adequately explain its risks can lead to significant client dissatisfaction and regulatory scrutiny. The core of the challenge lies in balancing the potential advantages of variable life insurance with its inherent complexities and the need for full disclosure. The correct approach involves a thorough needs analysis that prioritizes the client's stated objectives, risk tolerance, and financial capacity. This includes clearly explaining that the cash value and death benefit can fluctuate based on investment performance, and that the policy is subject to investment risk. It also requires detailing all fees and charges associated with the policy, as well as the surrender charges and potential tax implications of withdrawals or surrenders. This approach aligns with regulatory requirements that mandate suitability and full disclosure, ensuring that the client makes an informed decision based on their best interests. The ethical imperative is to act as a fiduciary, placing the client's needs above all else. An incorrect approach would be to focus solely on the potential for investment growth without adequately disclosing the associated risks, such as the possibility of losing principal or the impact of market downturns on the cash value and death benefit. This misrepresentation violates regulatory principles of full and fair disclosure and can lead to a finding of unsuitability. Another incorrect approach would be to downplay or omit information about the policy's fees and charges or the surrender provisions. This lack of transparency can mislead the client about the true cost and liquidity of the product, creating a false sense of security and potentially causing financial harm if the client needs to access funds prematurely. Failing to assess the client's risk tolerance and recommending a variable life insurance policy when the client is risk-averse would also be a significant ethical and regulatory failure, as it would not be suitable for their circumstances. Professionals should employ a structured decision-making process that begins with a comprehensive understanding of the client's financial goals, risk tolerance, and existing financial situation. This should be followed by an objective assessment of whether a variable life insurance policy is the most appropriate solution to meet those needs, considering all available alternatives. If variable life insurance is deemed suitable, the professional must then provide a clear, concise, and complete explanation of all policy features, benefits, risks, fees, and surrender provisions, ensuring the client understands the implications before making a decision. This process emphasizes informed consent and client-centric advice. Question 12. The audit findings indicate that a life insurance agent provided advice to a client regarding the tax implications of accessing cash value through policy loans, surrendering the policy, and the taxation of death benefits. The agent's advice was inconsistent across these three scenarios. Which of the following best reflects the accurate tax treatment of these life insurance policy events under U.S. federal tax law? Option A. All policy loans are considered taxable income to the policyholder at the time of withdrawal. Option B. Any cash value withdrawn from a life insurance policy, whether through a loan or surrender, is subject to capital gains tax. Option C. Policy loans are generally not taxable income as long as the policy remains in force and is not a modified endowment contract. Gains on surrender are taxable as ordinary income, and death benefits paid to a named beneficiary are typically income tax-free. Option D. Death benefits paid from a life insurance policy are always taxable to the deceased's estate for income tax purposes. The correct answer is C. Policy loans are generally not taxable income as long as the policy remains in force and is not a modified endowment contract. Gains on surrender are taxable as ordinary income, and death benefits paid to a named beneficiary are typically income tax-free. Explanation. This scenario is professionally challenging because it requires the agent to navigate the complex interplay of life insurance policy loans, surrenders, and death benefits within the specific tax regulations applicable to the LOMA 281 exam jurisdiction, which is assumed to be the United States for this context. Misinterpreting these tax implications can lead to significant financial detriment for the client and potential regulatory repercussions for the agent. Careful judgment is required to ensure the client receives accurate advice that aligns with their financial goals and tax obligations. The correct approach involves accurately advising the client on the tax treatment of policy loans, surrenders, and death benefits as defined by the Internal Revenue Code, IRC. Specifically, policy loans are generally not taxable income to the policyholder as long as the policy remains in force and is not a modified endowment contract, MEC. Upon surrender, any gain, cash surrender value exceeding the cost basis, is taxable as ordinary income. Death benefits paid to a named beneficiary are typically income tax-free. The agent must clearly communicate these distinctions to the client, enabling them to make informed decisions about policy utilization and its tax consequences. An approach that suggests all policy loans are taxable income upon withdrawal is incorrect because it fails to acknowledge the general tax-free nature of loans against a life insurance policy, provided it's not a MEC. This misstatement could unnecessarily deter clients from utilizing a valuable policy feature. An approach that advises the client that any cash value withdrawn, regardless of whether it's a loan or a surrender, will be subject to capital gains tax is incorrect. While gains on surrender are taxable, loans are not considered withdrawals of cash value in the same tax sense, and the tax treatment differs significantly. Furthermore, the distinction between ordinary income and capital gains is relevant only for taxable events, and not all cash value access triggers taxation. An approach that states death benefits are always taxable to the estate is incorrect. While there can be estate tax implications depending on the size of the estate and the policy ownership, the death benefit itself is generally received income tax-free by the named beneficiary. This misrepresentation could lead to confusion and incorrect estate planning. Professional decision-making in these situations requires a thorough understanding of the relevant tax laws and regulations. Agents should prioritize educating themselves on these nuances and consulting with qualified tax professionals when complex situations arise. The process involves 1. Identifying the client's specific situation and goals 2. Recalling or researching the applicable tax treatment for each potential policy action, loan, surrender, death benefit. 3. Clearly and accurately communicating these tax implications to the client. And 4. Documenting the advice provided. Question 13. What factors determine the most suitable annuity payout option for a client who is nearing retirement, has a spouse significantly younger and in good health, expresses a strong desire to leave a legacy for their children, and requires a substantial income stream to maintain their current lifestyle throughout retirement? Option A. The annuity option with the shortest guaranteed payout period. Option B. The advisor's familiarity with a particular annuity product. Option C. The client's desire for lifelong income for themselves and their spouse, coupled with their legacy objectives. Option D. The annuity option that provides the highest immediate monthly payout. The correct answer is C. The client's desire for lifelong income for themselves and their spouse, coupled with their legacy objectives. Explanation: this scenario is professionally challenging because it requires the financial advisor to balance the client's immediate financial needs and long-term security with the inherent trade-offs of different annuity payout options. The advisor must not only understand the mechanics of each option, but also effectively translate complex financial concepts into understandable terms for the client, ensuring the chosen option aligns with their unique circumstances and risk tolerance. This requires a deep understanding of the client's life expectancy, health, financial dependence, and desire for legacy. The correct approach involves a thorough needs analysis that prioritizes the client's stated objectives and financial situation. This includes understanding the client's desire for guaranteed income versus potential for growth, their need to provide for a surviving spouse or beneficiary, and their comfort level with the duration of payments. Specifically, recommending a joint and survivor annuity when the client expresses a strong desire to leave a legacy for their children and has a spouse who is significantly younger and in good health, while also needing a substantial income stream for their own retirement, is the most appropriate course of action. This option provides a guaranteed income for the client's lifetime and continues to provide income for their spouse after their death, addressing both immediate needs and the desire for spousal protection and legacy. This aligns with regulatory requirements to act in the client's best interest and provide suitable recommendations based on their individual circumstances. An incorrect approach would be to recommend a life annuity solely because it offers the highest immediate payout. This fails to consider the client's stated desire to provide for their spouse and potentially leave a legacy, potentially leaving the surviving spouse in a precarious financial position. This could be seen as a failure to meet the client's comprehensive needs and could violate suitability regulations. Another incorrect approach would be to recommend a period-certain annuity without fully understanding the client's long-term financial goals and the potential for outliving the payout period. If the client has a long life expectancy and no dependents, this might be suitable, but if they have dependents or a desire for lifelong income, it could lead to financial insecurity later in life. This would also be a failure to provide a suitable recommendation. Finally, recommending an annuity payout option based solely on the advisor's personal preference or a limited understanding of the client's financial dependence would be a significant ethical and regulatory failure. The advisor's role is to serve the client's best interests, not their own or based on incomplete information. The professional decision-making process should involve actively listening to the client's stated needs and concerns, conducting a comprehensive fact-finding process to understand their financial situation, risk tolerance, and life goals, and then clearly explaining the features, benefits, and limitations of each suitable annuity payout option. The advisor should then guide the client towards the option that best aligns with their unique circumstances, ensuring informed consent and a recommendation that is demonstrably in the client's best interest. Question 14. The risk matrix shows that an applicant for a life insurance policy has a history of a common, well-managed chronic condition and a profession that is generally considered low risk. However, the underwriter is aware of a recent news report detailing a rare but severe occupational hazard associated with a specific niche within that profession, which approach best aligns with sound underwriting principles and regulatory compliance. Option A. Classify the applicant based on the general low-risk nature of their profession and the well-managed chronic condition, without further investigation into the specific niche. Option B. Immediately assign a substandard risk classification due to the potential for the rare occupational hazard, without confirming if the applicant's role is affected. Option C. Decline coverage outright based on the possibility of the rare occupational hazard as a precautionary measure. Option D. Conduct further investigation to determine if the applicant's specific role within the profession is exposed to the rare occupational hazard, and then apply the underwriting manual's guidelines for the chronic condition and any identified occupational risk. Correct answer is A. Classify the applicant based on the general low-risk nature of their profession and the well-managed chronic condition, without further investigation into the specific niche. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the insurer's need to accurately assess risk with the ethical obligation to treat all applicants fairly and avoid discriminatory practices. The underwriter must apply underwriting guidelines consistently, while recognizing that individual circumstances may warrant exceptions or further investigation, all within the bounds of regulatory compliance. The correct approach involves a thorough review of the applicant's medical history, lifestyle factors, and occupation as presented, and then applying the established underwriting manual's guidelines for risk classification. This ensures that the premium charged accurately reflects the assessed risk, preventing adverse selection and maintaining the financial solvency of the insurance company. This approach is ethically sound and regulatorily compliant because it is based on objective risk factors and established underwriting principles, treating all applicants with similar risk profiles equitably. It adheres to the principle of fairness by not arbitrarily assigning a higher risk classification without sufficient justification based on the underwriting manual. An incorrect approach would be to automatically assign a substandard risk classification based solely on the applicant's stated occupation, without further investigation into the specific duties and safety protocols involved. This fails to adhere to the underwriting manual's detailed guidelines, which likely require a more nuanced assessment of occupational hazards. This could lead to an unfairly high premium for the applicant and potentially violate regulations prohibiting arbitrary discrimination. Another incorrect approach would be to overlook certain disclosed medical conditions because the applicant is young and appears healthy. This ignores the fundamental principle of underwriting, which is to assess future risk, not just current health. Failing to account for pre-existing conditions, even if currently managed, can lead to adverse selection and financial losses for the insurer, and may also be considered a breach of regulatory requirements for thorough underwriting. A third incorrect approach would be to base the risk classification on anecdotal information or stereotypes about individuals with similar backgrounds, rather than on the specific information provided by the applicant and the underwriting manual. This is discriminatory and unethical, as it fails to assess the individual's actual risk profile and violates principles of fairness and equal treatment. Such practices are often explicitly prohibited by insurance regulation. Professionals should employ a decision-making framework that prioritizes adherence to the underwriting manual, thorough investigation of all relevant applicant information, and consistent application of risk classification principles. This involves understanding the rationale behind each underwriting guideline, seeking clarification when necessary, and always acting with integrity and fairness towards the applicant, ensuring all decisions are justifiable and compliant with regulatory requirements. Question 15. Market research demonstrates that a significant portion of individuals seeking annuity products are primarily focused on immediate income generation to supplement retirement. However, a client approaches an insurance professional expressing a strong desire for an annuity that offers the highest potential for immediate cash value growth, citing a need for liquidity within the next 2 years. Which of the following approaches best addresses the client's stated need while adhering to regulatory requirements for suitability and fair treatment? Option A. Recommending an annuity product that prioritizes immediate cash value growth and liquidity, while clearly explaining the associated surrender charges and potential tax implications of early withdrawal. Option B. Focusing on an annuity product with a high commission structure that offers aggressive growth potential, without delving into the client's specific liquidity timeline or risk tolerance. Option C. Suggesting a fixed annuity with a guaranteed interest rate, emphasizing its safety and long-term growth potential, regardless of the client's stated need for liquidity. Option D. Advising the client to invest in a variable annuity with a broad range of sub-account options, highlighting the potential for significant market-linked returns without thoroughly assessing their comfort level with market volatility. The correct answer is A, recommending an annuity product that prioritizes immediate cash value growth and liquidity, while clearly explaining the associated surrender charges and potential tax implications of early withdrawal. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the client's stated immediate needs with a more comprehensive understanding of their long-term financial security and risk tolerance, all while adhering to regulatory requirements for suitability and fair treatment. The pressure to close a sale can sometimes overshadow the obligation to ensure the product truly meets the client's underlying needs. Careful judgment is required to avoid misrepresenting the product or failing to uncover crucial information that would alter the recommended solution. The correct approach involves a thorough risk assessment that goes beyond the client's initial request. This means actively probing to understand the client's overall financial situation, their attitude towards risk, their existing insurance coverage, and their future financial goals. This comprehensive understanding allows the professional to identify potential gaps or mismatches between the client's stated needs and their actual requirements for financial protection and long-term security. This aligns with regulatory principles that mandate suitability, ensuring that any recommended insurance or annuity product is appropriate for the client's individual circumstances, objectives, and risk tolerance. It also upholds ethical obligations to act in the client's best interest. An incorrect approach would be to simply accept the client's stated desire for a specific product without further investigation. This fails to meet the regulatory requirement for suitability, as it assumes the client fully understands their own needs and the implications of the product they are requesting, which is often not the case. Ethically, this approach prioritizes a quick sale over the client's well-being. Another incorrect approach is to focus solely on the features of a particular annuity product that might offer higher commissions, without adequately assessing if those features align with the client's risk profile or long-term objectives. This represents a conflict of interest and a failure to act in the client's best interest, potentially leading to regulatory sanctions for misrepresentation or unsuitable sales practices. A third incorrect approach is to present a complex annuity product with numerous riders and options, without clearly explaining the associated costs, benefits, and potential drawbacks in relation to the client's specific situation. This can lead to a misunderstanding of the product's true value and suitability, violating principles of transparency and fair dealing. The professional decision-making process should involve a structured needs analysis that begins with open-ended questions to understand the client's situation, followed by targeted questions to clarify their financial goals, risk tolerance, and existing resources. The professional should then use this information to identify potential solutions, explaining the rationale behind each recommendation, and ensuring the client understands how the proposed product addresses their identified needs and fits within their overall financial picture. This process ensures compliance with suitability regulations and upholds ethical standards of client care. Question 16. The review process indicates that a client has expressed a desire for a life insurance policy that provides a guaranteed death benefit and builds cash value over time, suggesting whole life insurance. However, the client also mentioned a need for potential access to funds for unexpected future expenses. Which of the following approaches best aligns with regulatory expectations for meeting customer needs with insurance and annuities? Option A. Recommend a term life insurance policy with a rider for cash value accumulation, as this might offer more flexibility for accessing funds compared to traditional whole life insurance. Option B. Recommend a whole life insurance policy, highlighting its guaranteed death benefit and cash value accumulation, while also explaining how the cash value can be accessed through policy loans or withdrawals, and discussing the surrender charges associated with early termination. Option C. Advise the client that whole life insurance is the only product that offers a guaranteed death benefit and cash value, and proceed with the sale without exploring alternative solutions or discussing potential access to funds. Option D. Immediately issue a whole life insurance policy based on the client's stated desire for a guaranteed payout, without further discussion of their financial goals or other potential needs. The correct answer is B. Recommend a whole life insurance policy, highlighting its guaranteed death benefit and cash value accumulation, while also explaining how the cash value can be accessed through policy loans or withdrawals, and discussing the surrender charges associated with early termination. Explanation. This scenario is professionally challenging because it requires the agent to balance the client's stated needs with the inherent features and limitations of whole life insurance, ensuring the recommendation aligns with regulatory expectations for suitability and fair treatment. The agent must avoid misrepresenting the product or pushing a solution that doesn't genuinely meet the client's objectives, especially concerning long-term financial planning and potential liquidity needs. The correct approach involves a thorough needs analysis that goes beyond the client's initial request to understand their broader financial goals, risk tolerance, and time horizon. This allows the agent to determine if whole life insurance, with its guaranteed death benefit, cash value accumulation, and lifelong coverage, is indeed the most suitable product. Regulatory frameworks for insurance sales, such as those governing suitability and disclosure, mandate that recommendations be in the client's best interest. This approach ensures compliance by prioritizing client needs and providing accurate information about the product's characteristics, including its long-term nature and potential surrender charges. An incorrect approach would be to immediately recommend whole life insurance solely based on the client's expressed desire for a guaranteed payout, without exploring the underlying reasons or considering alternative solutions. This fails to meet the regulatory requirement of conducting a comprehensive needs analysis and could lead to a recommendation that is not suitable for the client's overall financial situation. Another incorrect approach is to overemphasize the cash value growth potential without adequately explaining the associated risks, fees, and surrender charges, which constitutes a misrepresentation and violates disclosure obligations. Finally, recommending whole life insurance without discussing its illiquidity and comparing it to more liquid options for potential emergency funds would also be a failure to meet the client's potential needs for accessible funds, thereby not acting in their best interest. Professionals should employ a structured decision-making process that begins with active listening and comprehensive fact-finding regarding the client's financial situation, goals, and concerns. This should be followed by an objective assessment of how different insurance products, including whole life, align with those identified needs. Transparency and clear communication about product features, benefits, limitations, and costs are paramount. If a product like whole life insurance is deemed suitable, the agent must clearly articulate why it is the best fit compared to other available options, ensuring the client makes an informed decision. Question 17. Market research demonstrates that customers are more likely to feel confident and satisfied with insurance and annuity recommendations when they perceive their advisor truly understands their personal circumstances and financial aspirations. Which of the following approaches best exemplifies building rapport and trust in this context? Option A. Presenting a pre-selected best-fit product based on general demographic information, assuming it will meet most needs. Option B. Using industry-specific terminology and complex financial models to impress the customer with the advisor's expertise. Option C. Asking broad, open-ended questions about the customer's life goals, financial concerns, and comfort level with risk, and actively listening to their responses before discussing potential solutions. Option D. Focusing the initial conversation on a detailed explanation of the various product features and investment options available, highlighting their potential returns. Correct answer is D. Focusing the initial conversation on a detailed explanation of the various product features and investment options available, highlighting their potential returns. Explanation. This scenario is professionally challenging because building rapport and trust is foundational to meeting customer needs ethically and effectively, especially in the context of insurance and annuities. Misjudging how to establish this connection can lead to misaligned product recommendation, customer dissatisfaction, and potential regulatory scrutiny. The core of the challenge lies in balancing the need to understand the customer's situation with the imperative to act in their best interest, avoiding undue pressure or misrepresentation. The correct approach involves actively listening to the customer, asking open-ended questions to understand their financial goals, risk tolerance, and life circumstances, and then clearly explaining how potential insurance or annuity products can address those specific needs. This method prioritizes the customer's perspective and ensures that recommendations are tailored and transparent. This aligns with the ethical obligation to act as a trusted advisor and the regulatory expectation to recommend products suitable for the customer's situation. It fosters a relationship built on understanding and mutual respect, which is crucial for long-term customer satisfaction and compliance. An incorrect approach would be to focus solely on product features and benefits without first understanding the customer's individual needs. This fails to establish genuine rapport and can lead to recommending products that are not appropriate, potentially causing financial harm to the customer. Ethically, it demonstrates a lack of client centricity. Another incorrect approach is to use overly technical jargon, complex explanations that confuse the customer. While aiming for thoroughness, this can inadvertently create a barrier to understanding and erode trust, as the customer may feel overwhelmed or that information is being withheld. This can also lead to a situation where the customer agrees to a product without fully comprehending its implications, which is a failure in both ethical and regulatory duty to ensure understanding. A third incorrect approach involves making assumptions about the customer's financial situation or needs based on superficial information or stereotypes. This is a significant ethical lapse and a regulatory risk, as it bypasses the essential step of gathering accurate information and can lead to inappropriate product recommendations. It undermines the very foundation of trust and personalized service. Professionals should employ a decision-making process that begins with a commitment to understanding the customer's unique situation through empathetic listening and probing questions. This information should then guide the selection and explanation of suitable products, always prioritizing clarity, transparency, and the customer's best interests. Regular self-assessment of communication techniques and a focus on building a long-term relationship, rather than just a single transaction, are key to navigating these challenges effectively and ethically. Question 18. Assessment of how an insurance agent should advise a client seeking to minimize premium costs while also considering the implications of a preferred provider organization (PPO) plan on their healthcare provider choices and potential out-of-pocket expenses. Option A. Recommend a PPO plan as the best option for cost savings, assuring the client that network restrictions are minimal and that they can easily access any doctor they wish without substantial additional expense. Option B. Focus solely on the premium savings of a PPO plan, without detailing the specifics of network provider limitations or the potential for increased out-of-pocket expenses if out-of-network services are utilized. Option C. Explain that a PPO plan typically has lower premiums but restricts provider choices to a network, and that out-of-network care will likely incur significantly higher costs, requiring careful consideration of preferred providers. Option D. Advise the client that a PPO plan will offer lower premiums and provide access to a wide range of healthcare providers, with minimal differences in out-of-pocket costs compared to other plan types. Correct answer is D. Advise the client that a PPO plan will offer lower premiums and provide access to a wide range of healthcare providers, with minimal differences in out-of-pocket costs compared to other plan types. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance agent to balance a client's desire for cost savings with the potential limitations of a preferred provider organization (PPO) network. The agent must ensure the client fully understands the implications of network restrictions on their healthcare choices and associated costs, thereby avoiding misrepresentation and upholding ethical obligations. Correct approach analysis. The correct approach involves clearly explaining to the client that while a PPO may offer lower premiums, it restricts their choice of healthcare providers to those within the network. This explanation must include the potential for higher out-of-pocket costs if they choose providers outside the network, and that the PPO's coverage is contingent on using in-network services. This aligns with regulatory requirements to provide accurate and complete information to enable informed decision-making, preventing potential client dissatisfaction and regulatory scrutiny for misrepresentation. Incorrect approach is analysis. Recommending the PPO solely based on lower premiums without detailing network restrictions and out-of-network cost implications is an ethical failure. It misleads the client into believing they have broader coverage than they do, potentially leading to unexpected expenses and a breach of trust. This also violates the principle of full disclosure mandated by insurance regulations, suggesting that the PPO offers the same level of flexibility as an HMO, but with better pricing, is factually incorrect and misleading. This misrepresentation can lead to significant client confusion and financial hardship if they later discover the network limitations. It directly contravenes regulations requiring accurate product descriptions. focusing only on the potential for future cost savings without adequately explaining the current network limitations, and the client's responsibility for out-of-network costs is also an incomplete and potentially deceptive practice. It prioritizes a future benefit over present realities, failing to provide a balanced and transparent view of the product. Professional reasoning. Professionals should employ a decision-making framework that prioritizes client understanding and informed consent. This involves 1. Actively listening to the client's needs and priorities, cost, provider choice, coverage. 2. Thoroughly explaining the features and limitations of each product option, using clear and understandable language. 3. Quantifying potential out-of-pocket expenses for both in-network and out-of-network scenarios where applicable. And 4. Ensuring the client confirms their understanding and agreement with the chosen product's terms and conditions. This process ensures compliance with ethical standards and regulatory mandates for fair dealing and accurate representation. Question 19. Upon reviewing the options for a new employer-sponsored group health insurance plan, the HR department is presented with several proposals. One proposal offers a significantly lower monthly premium, but features a limited network of in-network providers and higher deductibles and co-insurance for most services. Another proposal has a slightly higher premium, but includes a broader provider network and more favorable cost-sharing arrangements. The employer's primary objective is to control costs while ensuring employees have access to quality health care. Which approach best balances these competing objectives and adheres to regulatory expectations for employer-sponsored health plans? Option A. Choose the proposal that offers a broader provider network and more favorable cost-sharing arrangements, even with a slightly higher premium, after verifying it meets all regulatory benefit mandates. Option B. Prioritize the proposal that includes the most innovative wellness programs, as these are expected to reduce overall healthcare utilization and costs over time. Option C. Opt for a high-deductible health plan with a health savings account, HSA, option, as this is generally the most cost-effective for both the employer and employees in the long run. Option D. Select the proposal with the lowest monthly premium, as cost control is the primary objective and employees can seek out-of-network care if necessary. The correct answer is D. Select the proposal with the lowest monthly premium, as cost control is the primary objective and employees can seek out-of-network care if necessary. Explanation. This scenario presents a common implementation challenge in group health insurance, balancing the employer's desire for cost containment with the regulatory and ethical obligation to provide adequate coverage that meets employee needs. The challenge lies in interpreting adequate and cost-effective within the framework of applicable regulations, specifically those governing employer-sponsored health plans. Professionals must navigate the complexities of plan design, provider networks, and benefit levels while ensuring compliance with laws designed to protect employee welfare and prevent discriminatory practices. The correct approach involves a thorough understanding of the employer's financial constraints and employee demographics, coupled with a diligent review of available plan options that offer a reasonable balance of cost and comprehensive benefits. This includes evaluating the breadth and depth of provider networks, the structure of cost-sharing mechanisms, deductibles, co-pays, co-insurance, and the inclusion of essential health benefits as mandated by relevant regulations. The ethical and regulatory justification for this approach is rooted in the fiduciary duty employers have to their employees regarding health benefits and the legal requirements to offer plans that are not unduly restrictive or discriminatory. It prioritizes employee well-being and access to necessary care while remaining financially responsible. An incorrect approach would be to solely prioritize the lowest premium cost without a comprehensive assessment of benefit adequacy. This could lead to a plan with a narrow provider network, high out-of-pocket expenses, or insufficient coverage for essential services, potentially violating regulations that mandate minimum coverage standards or prohibit plans that effectively exclude employees from accessing care. Another incorrect approach would be to select a plan based on a superficial understanding of employee needs, perhaps by assuming all employees have similar healthcare requirements. This overlooks the diversity of health statuses and medical needs within a workforce, leading to a plan that may not adequately serve a significant portion of the employee population and could raise concerns about fairness and equity. A third incorrect approach might involve relying solely on the recommendations of a single insurance provider without independent due diligence, potentially missing more suitable or cost-effective options from other carriers, or failing to identify potential conflicts of interest. Professionals should employ a decision-making framework that begins with clearly defining the employer's objectives and budget. This should be followed by a comprehensive needs assessment of the employee population, considering factors like age, family status, and common health concerns. Subsequently, a broad market scan of available group health insurance products should be conducted, with a focus on comparing benefit structures, provider networks, and cost-sharing arrangements against regulatory requirements and employee needs. Finally, a comparative analysis of the most suitable options, considering both cost and coverage quality, should inform the final selection, ensuring transparency and clear communication with the employer throughout the process. Question 20. Governance review demonstrates that an insurance advisor, when discussing a deferred annuity with a client, learns that the client anticipates needing access to a significant portion of the funds within 3 years due to a planned home renovation. The annuity features substantial surrender charges for withdrawals made within the first 5 years. The advisor, eager to meet their quarterly sales targets, is considering proceeding with the sale, believing the client might change their mind about the renovation timeline or be willing to absorb the surrender charges. What is the most appropriate course of action for the advisor? Option A. Proceed with the sale, emphasizing the long-term growth potential of the annuity and assuring the client that they can likely manage the surrender charges if the need arises. Option B. Suggest that the client delay the renovation plans for at least 5 years to avoid surrender charges, thereby making the annuity a suitable option. Option C. Fully disclose the surrender charges and the potential financial impact of early withdrawal. Explain that the annuity is likely unsuitable given the client's stated short-term liquidity needs, and explore alternative products that better align with the client's immediate financial goals. Option D. Recommend the annuity, but advise the client to set aside separate funds to cover potential surrender charges, without fully explaining the implications of this strategy. The correct answer is C. Fully disclose the surrender charges and the potential financial impact of early withdrawal. Explain that the annuity is likely unsuitable given the client's stated short-term liquidity needs, and explore alternative products that better align with the client's immediate financial goals. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial needs of a client with the long-term suitability and regulatory compliance of an annuity product. The advisor is under pressure to close a sale, but the client's circumstances suggest a potential mismatch with the annuity's features, raising concerns about fiduciary duty and regulatory adherence. Careful judgment is required to ensure the client's best interests are prioritized over potential commission. The correct approach involves recognizing the potential unsuitability of the annuity given the client's stated need for immediate access to funds, and the annuity's surrender charges and tax implications for early withdrawal. This approach prioritizes the client's financial objectives and risk tolerance, aligning with the principles of Know Your Customer (KIC) and suitability regulations. Specifically, under the regulatory framework for the Meeting Customer Needs with Insurance and Annuities exam, LOMA 281, which emphasizes ethical conduct and client-centric sales practices, an advisor must ensure that any recommended product is appropriate for the client's specific situation. This includes understanding the client's liquidity needs, investment objectives, and time horizon. Recommending a product that does not meet these criteria, even if it offers a higher commission, would violate ethical obligations and potentially regulatory requirements related to suitability. An incorrect approach would be to proceed with the sale despite the identified concerns. This failure stems from prioritizing sales targets or commissions over the client's well-being. Such an action directly contravenes the spirit and letter of regulations designed to protect consumers from unsuitable financial products. Specifically, it disregards the fundamental principle that an annuity recommendation must be based on a thorough assessment of the client's needs and circumstances. Pushing the annuity without addressing the liquidity issue and surrender charges would be a breach of the advisor's duty to act in the client's best interest and could lead to regulatory penalties for misrepresentation or selling unsuitable products. Another incorrect approach would be to downplay the client's concerns about liquidity and surrender charges without providing a clear and comprehensive explanation of the product's limitations and the potential financial impact on the client. This misrepresents the product's features and benefits, failing to provide the client with the necessary information to make an informed decision. Ethically and regulatorily, full disclosure of all material facts, including fees, charges, and limitations, is paramount. A third incorrect approach would be to suggest that the client's concerns are minor and can be easily overcome without a detailed analysis of the annuity structure and the client's financial situation. This dismisses the client's valid questions and demonstrates a lack of due diligence in assessing the product's suitability. It suggests a superficial understanding or a deliberate attempt to overlook potential problems to secure a sale. The professional reasoning process for similar situations should involve a structured approach. 1. Thoroughly assess the client's financial situation, objectives, risk tolerance, and liquidity needs. 2. Understand the features, benefits, limitations, and costs of all recommended products. 3. Identify any potential mismatches between the client's needs and the product's characteristics. 4. Clearly and transparently communicate these potential mismatches and their implications to the client. 5. If a product appears unsuitable, explore alternative solutions that better meet the client's needs or advise against the sale. 6. Document all client interactions, assessments, and recommendations to demonstrate compliance and adherence to ethical standards.